Hello and welcome to the Uber Freight fourth quarter market update and outlook. I'm Russell Zuppo. I'm the Vice President of Commercial Insights and Analytics here at Uber Freight. I'm here with Nathan Adams, who is a Vice President of Procurement, and Mazen Danoff, who's our Senior Applied Scientist and who I like to call the Freight Economist. So our agenda today is going to be the same as it's been. Mazen's going to kick us off into some macro economics and really look at the transportation market. I'm going to show some 4PL data to sort of back that up and to show what we're seeing with actual operational data. And Nathan's going to come in and talk a little bit more about procurement and procurement trends and what to expect on the procurement front. We'll finish with some Q&A after that. So with that, I will turn it over to Mazen to talk about.
Thank you, Russell, and good morning, everyone, or good afternoon. So I'll be covering some of the demand and supply signals we're seeing in the freight market and what are the expectations for the year ahead. So starting with the most important demand signals, the biggest headwind continues to be manufacturing demand. So that's the biggest headwind facing the freight market. The manufacturing sector continues to contract according to several indices. What I'm showing here is the ISM PMI, or the Purchasing Managers Index. This is an index that tracks the overall health of the manufacturing economy. Any observation here below 50 indicates contraction, and anything above 50 indicates expansion. We've seen very few components of this index showing expansion in the last few months. Production was hovering above and below 50, indicating almost flat levels of production. Backlogs and new orders, so these are the early indicators of demand or the future indicators, they are both in contraction. So they're pointing to a weaker outlook than where we currently are. The employment index is also in contraction, indicating layoffs or headcount reductions. And the only index that is surpassing 50 by a wide margin is prices. This indicates inflation facing manufacturers in the prices of commodities and raw materials, which was mostly due to tariffs. So if you look at other indices, they also support the same narrative. The Fed's manufacturing index has been revised significantly lower. So what we thought was flat over the last 2 years turns out to be significantly lower than what we originally had thought. In addition to that, we've seen declining imports. For four consecutive months right now, we have seen imports decreasing month over month since between July and November. This chart shows the year-over-year import levels, and right now we're about -7% to -8% lower than the year-ago levels of imports. Of course, July was an outlier month where we saw a lot of pre-stocking ahead of tariffs, but after that wave of pre-stocking has ended, we've seen imports declining. Specifically, imports from China have decreased significantly over the last year, falling about 20% year-over-year. Across all demand indicators, the only sector that seems to be doing well is retail or consumer-driven demand. So just last week, we received two strong signals. Black Friday sales were the strongest we've seen in history, totaling 11.7 billion in online sales. That's more than an 8% growth year-over-year. Cyber Monday sales were even larger than that at $14.2 billion in online sales, also a 6.7% growth year-over-year. Total holiday spending is also expected to hit a record level, according to Adobe Analytics, hitting to $253.4 billion in sales, and that exceeds a 5% growth year-over-year. Well, it's important to note that holiday spending and e-commerce are outpacing general retail, but general retail is still in a healthy position. So we've seen retail sales growing 3.9% year-over-year, if you look at data from the US Census. And even after we adjust for price inflation, which is about 1.5% in goods inflation specifically, real retail spending, or what we call inflation-adjusted retail spending, is estimated about 2.4% year-over-year. So that's all on the supply side. Now, shifting to the demand side, we look at a couple of indicators on the demand side, particularly leading indicators like tractor orders and tractor sales, which are shown in this chart. So tractor orders are shown in the red line, and tractor sales are shown in black, and production is shown in green here. Focusing on orders, we notice a seasonal pattern in this data. So right now, during this time of the year, we're supposed to be in what we call peak tractor ordering season, which extends from October until December, and we see most of the orders placed for the coming year. This year, the peak season appears to be significantly weaker than the prior peak seasons. So it's weaker than 2024, which was in turn weaker than the prior years, 2022 and 2023. So we're seeing carriers being more conservative in ordering tractors and trailers. And that indicates that they're struggling because of this weak market. They're not willing to invest in new equipment as long as the market hasn't recovered yet. Well, weak tractor orders translate to a tighter capacity in the second half of the year. So this might be one of the factors that could drive tightening in the second half of 2026. It's important to note that this trend is also evident in tractor sales. So sales are negative year over year, and we're talking about double-digit negative. So they're down more than 20 or 30% year over year, and tractor production is also lower by a similar magnitude. The same trend is observed in trailers as well. So if you look at orders for specifically dry van trailers, we see similar trends. And since these are orders and sales of new tractors, they're more indicative of larger fleet capacity. So in the last couple of years, we've seen most of the capacity reductions being concentrated among smaller fleets or owner-operators. But now we're starting to see a significant capacity correction as well, or capacity reduction among larger fleets. So speaking of smaller fleets, we're also tracking the FMCSA data showing carriers entering and exiting the market, which is shown in this chart here. So the green bars indicates carriers entering the market, and the red bars indicate carriers exiting the market. The black line indicates the net change in the number of carriers. So it's the difference between new entrants and exits. And while we've seen this net carrier population being flat for the last year, so we haven't seen a significant change, there might be some new developments that indicate significant capacity corrections over the next year. The two most important developments that were discussed thoroughly are the English language proficiency rule and the non-domiciled carrier rule. For the English language proficiency, or what you call the ELP rule, it requires drivers to be proficient at English. And this rule affects about 20,000 drivers, or slightly more than 20,000 drivers, which is a small number. So it's not expected to significantly impact the level of supply in the market. In addition, over 70% of violations do not result in drivers being completely removed from the market. And most of these violations occur at the border, so they rarely impact inland capacity in the US. The other more important rule is the non-domiciled CDL rule, which prevents states from either renewing or issuing new CDLs to non-domiciled carriers. Over the next couple of years, FMCSA expects this to remove about 200,000 drivers from the freight market if it passes. Now, this rule is being challenged in court, so we don't know if it will pass or not. If it passes, it could lead to a significant market tightening in 2026. So this is the most important thing to watch, in my opinion, over the next couple of months, whether this rule will pass or not. And it's important to track FMCSA data showing the number of affected carriers or the number of affected drivers as a result of enforcing this rule. So that was all on the supply side. Given what we discussed about demand and supply, where we stand right now and what are the expectations for the year ahead, in general, we saw Q4 seeing an increase in rates, in spot and contract rates, but particularly spot rates, which is expected for this time of the year. So when we look at van and reefer rates, they increased in October and November. They're increasing as well in December. Flatbed rates are decreasing because this is a seasonally weak period of the year for flatbed. When we look at contract rates, we've also seen slight increases, putting them slightly positive year over year, maybe in the range of like 1 to 2% year over year, but not a major increase yet. So looking ahead, this also shows spot rates year over year. We've seen that spot rates were tracking very closely to the levels that we saw in 2024, except that it's slightly above these levels. So think of it as like a parallel of the 2024 levels, but slightly above these levels by low single digits, ranging between 0 to 5% for the whole year. December is seeing values slightly more than that, maybe like between a 5 to 8% growth over last December. And we're seeing some significant tightening during these couple of weeks, but this is just seasonal, as I said. So looking ahead, the persistent recession in manufacturing and in housing will continue to weigh down on freight demand. So we're not seeing any signals of a demand shock or a demand increase that could drive rates higher. One of the most important developments that we could see in 2026 could be the tariff dividends. But so President Trump promised $2,000 in tariff dividends for individuals making less than $150,000 or $100,000. This will affect about 150 million individuals in the US and could lead to a demand surge. But so far, tariff revenues are much lower than what is required to cover the costs of these dividends. So this will certainly not happen in the first half of 2026. However, with that being said, even though we're not expecting a change on the demand side, we are expecting capacity to tighten on the supply side. So we're expecting capacity to continue to exit the market, either through carriers reducing their headcount or more carriers exiting the market or more carriers being removed from the market due to enforcement. So because of that, we're expecting an incremental increase in rates in 2026, also in the range of low single digits or like single digits, similar to what we saw this year. However, we're also considering a tight scenario where the CDL non-domiciled carrier rule goes into effect, and this will tighten the capacity significantly. So my recommendation to shippers is to consider two scenarios: a baseline scenario where we see like an almost flat or a slightly incremental increase in spot rates. And in 2026, it could see this tight scenario where we see capacity being completely removed from the market or like removed in a significant amount from the market. And that leads to rates surging maybe more than 20% and contract rates increasing in the range of 5 to 10% as well. So my recommendation is to consider these two scenarios. The reason is that we don't know what will happen with the non-domiciled carrier rule. It might pass, it might not. As for the next couple of months, we expect the market to soften from where we're currently at. So the map to the left shows where we are in December in terms of spot market tightness. Red means tighter and blue means softer. And right now, most of this map is in the red. So maybe with the exception of Florida and Georgia and a few other markets, we're seeing tightness almost everywhere in the US, particularly in the Pacific Northwest. By February, which is the map shown to the right, most of this tightness usually resolves, especially in the southern part of the US. So markets like California, Texas, and Florida tend to soften further. The Pacific Northwest softens significantly. And some tightness might persist in the northern markets because of weather disruptions, but it is significantly softer than where we are right now. So that's the short-term outlook. Next, Russell will be covering the trends we're seeing on the TM platform.
Thank you, Mazen. So what I'm going to do is cover some data that we see from our managed transportation platform. That's about, I'd say, a little over $16 billion of freight under management that we're aggregating to get these results. And the first thing I like to look at here is really the carrier tender acceptance. And so all indicators are saying the market's remaining favorable. It's pretty flat, as you can see from 23 till current. There are what I would call seasonal dips here. And you can see right now we're starting to go into a little bit of a seasonal dip. Doesn't appear that it'll be quite as bad as maybe last year as far as the holiday week, but generally we can always expect some driver tightening towards the end of the year, and driver availability becomes scarce during that Christmas week. But what we're looking at specifically here is we're looking at the first tender acceptance. So that's the first tender that goes out to carriers. Are they accepting or not? Overall, very high levels at 92%. And again, with very slight degradation there as we approach the end of the year. The second is route guide compliance. So that's either the first tender being accepted or staying on the route guide and not going to spot for those loads. And that's generally just a little higher, and it's at 94%. Both really high, both really excellent for shippers. And then the last thing, which is really where it hits your pocketbook, right, which is inflation over the primary carrier. And that's really looking at, so in the cases where we do reject it, how much of an inflation are we seeing? Because a lot of times rejection, even though the spot market might be generally lower, a lot of times rejection causes last minute loads to have to be tendered, and those tend to be a little more expensive. So right now we're about 1.7% there with again, expecting a sharp but not really significant increase towards the end of the year into the holiday weeks. When we just double click this and we look across all modes, we see that, it's really flat. It's every mode's performing well. I also say I don't have a slide specific for bulk, but bulk is also very flat and very, very stable as well. Dry van is showing a little bit of degradation quarter over quarter. It's the one thing that's, we want to keep our eyes on, but it's also somewhat expected with the seasonal changes. A lot of dry goods and a lot of, like Mazen had pointed out, a lot of, Black Friday shipments are happening right now. And then the other call out here, I'd say, is intermodal. So last quarter, we were looking at intermodal, and there was some regional container pressures, some regional tightness driving acceptance down a little bit there, but that's back up to really good levels on near 100%. Next thing I like to look at is on-time service, and that seems to be trending up ever so slightly year over year, probably more related to both shippers and carriers, comfortable in this environment, getting better, creating efficiency, creating better service. In this sense, we like to use the original must arrive by date. So it's a little bit of a representation, not of carrier performance, although that plays into this. It's a representation of more like supply chain performance. And so that's trending around 78%. And overall, very good. It doesn't appear that the dip's going to be as big this year, and it definitely appears that as we've gone through the year, we've been a little bit higher than last year. So that's all trending in the right direction for shippers. So from the data, everything looks positive and everything looks fairly stable at the moment. That is what I'm covering for our transportation management data and trends. I'm going to send it over to Nathan Adams to talk about procurement.
Cool. Thanks, Russell. And hey everybody, Nathan Adams, Vice President over Procurement and Carrier Management here at Uber. I will say, just from a admin standpoint, the Q&A is open. So if you guys do have Q&A, any questions, if you want to drop them in that side chat there for us, we will start doing some Q&A after this and kind of have some open discussion as well. So high level, I wanted to walk you through just kind of what we're seeing from a procurement standpoint, right? And I say folks who are in the procurement space probably haven't, probably think it's kind of like business as usual, and it does feel like it. Kind of feels like Groundhog's Day, kind of doing the same thing over quarter. I think a lot of folks, no changes in, how they're looking at their annual RFP. A lot of folks are still wanting to put that out to bid holistically. There's all the conversation always when it gets tight about, do we split things up? Do we do multiple bids? Obviously in a loose market, it's a lot easier just to kind of bundle it all up and put it out there. So nothing around that change in bid cycles conversation yet. We did see kind of an extended RFP season. So I think this year folks kept trying to pull some RFPs back. Typically a lot of folks running that November to January, start time, and we saw a lot of folks start trying to pull that back up to kind of get the market and say, hey, maybe stave off any of the pricing pressures that may or may not have materialized. Some of the stuff Mazen was talking about. So still seeing, had that pull up, and we're getting quite a bit more, in the hopper for, bids in Q1, right? So we've got a lot of folks who have, we've bid for in the past. We're not only doing those, we're getting a lot more folks wanting to come in and build their network. So I think a lot of folks are saying, hey, this is a lot of the market still, based on a lot of the pressures out there. It's probably a really good time to try to get some rates as a shipper, and get them locked in and see if we can hold them, depending on some of the things that Mazen talked about around upcoming litigation policy, et cetera. So just from an overall strategic trend, like, shippers are still trying to keep their incumbents whole as much as possible. I'd say a lot of the shippers understand where the carrier base is right now. They work with them through the RFP cycle to understand what their network is doing, et cetera, and really try to partner with the carrier standpoint, and work with their incumbents to keep them whole in their network. I'd say 2 rounds is still kind of the norm. That's always another question that comes up is, should I do 3 rounds? Should I do 1 round? Take it or leave it price. We still say, 2 rounds is kind of the best practice with some expressive feedback in there, and really help drive that negotiation down in between the rounds with the carrier base. I'd say from a decision standpoint, we continue to see folks, try to understand and struggle with where do I draw that line of what do I bid and what do I consider low volume, what should fall to spot, what should fall to contract. And so that tail freight, even though those lanes may be small for folks, add them up and it's quite a bit of volume, right? So how do we manage that from a low volume standpoint? So that's typically a pretty heavy conversation in everyone's network. From a carrier standpoint, we continue to see carriers cast a wide net. We measure participation percentage and the percentage that they actually will bid across lanes, and both those are still very strong. You'll see those drop in tightening markets, and both are very strong around participation, and then also just percent of the bid coverage that their carriers are bidding on. Obviously those that follow carrier earnings, there's a lot of mixed carrier earnings out there in the marketplace. A lot of folks have announced they've lost freight or the market, et cetera, and they're still trying to figure out how to replace that in some cases. Most of it should be all taken out, but a lot of it is kind of got replacements heading into next year. So brokers continue to be really aggressive, right? So I think you'll still see the brokerage world kind of come in very aggressive, trying to make sure they secure some freight before the market turns. And obviously when the rates are depressed, it really drives a lot of those brokers to try to gather up that business and just kind of try to volume their way out of the economic times, right? And I'd say just overall from a price standpoint, I'll echo what Mazen said and Russell said, and I'll go ahead and transfer to the next slide here. So this is the top line is the black line is where we kind of start from a scenario planning standpoint, from a saving standpoint. So when you go and model your network initially, you're always going to have a save or a almost looks like a number that there's no way we could get to that. And when you look at the carrier base, it's just kind of a mismatch of everybody who's bid in a low rate, right? And so obviously awarding that wouldn't be a stable network, right? So that blue line is where it actually gets awarded from a save standpoint. And as you can see, this whole the last 4 quarters are just kind of bouncing up and down, bouncing off the bottom. And so our RFP results are kind of echoing what we're seeing in the marketplace, right? Just from a rate standpoint, there's still save out there, there's still saving pieces as you can go get it, but I'd say we're definitely at the bottom, and I think we've been talking about that for a bit too. So lastly, just what do we think from a recommendation standpoint? So what's all this mean when I'm looking at procuring my network, right? It's a good time to lock in rates. We've talked about rates are, we think they're bouncing off the bottom. There's a lot of pressures in the marketplace, not only from just a supply demand balancing and just a market recovery from an incremental standpoint, but also the policy and legislation that Mazen referenced. That's something definitely to keep an eye on. But yeah, a lot of folks unknown to that are still going ahead and locking in rates, right? It's good to diversify your carrier base. It's always good to bring in additional carriers, even in downtimes, right? You think of the example again. I'll go back to the CDL thing. Is if that goes active and carriers have a hard time finding drivers, you're going to have more carriers in that pool to kind of manage your business, right? As you work through that. I'd say strengthen your partnership with the carriers. Again, you bring your guys closer to you, understand what they're doing, what they think about the upcoming year, like what they're concerned about their driver base, and really try to understand where your core carriers are coming from. From a refrigerated standpoint, produce season is always there, right? It's always good to book some of that stuff early if you can. A lot of the refrigerated bids have already started to kind of hit the market out there. Cross-border is going to be a pain point. So if you start getting into the reefer business and the cross-border business, there's probably some more strategic conversations you need to have with the carrier base. Using a blended strategy is good. What we talked a little bit about that, like where do you do the cut between contract and spot, and then just a little bit on bulk. Like we're trying to hit some of these like more specialized modes as well while we talk here. But how do you strengthening your long-term relationship with the bulk carriers? How do you work on like being a shipper of choice? these markets and these modes always seem to tighten up quicker than your general drive-in, right? Just due to the specialized and the driver base, et cetera. So anything you can do to kind of foster those specialized mode in your network is it'll pay off, in 26 if things kind of, turn around. So I think that is my last slide, and yeah, I think we can just start going to Q&A. So I'll lead that, and then call on Russell and Mazen back up here on the virtual stage to help out, right? Okay, so here's one for probably the group, Mazen, Russell, maybe. So could you clarify the origin of the product that is supplying the holiday spending reaching an all-time high, considering that everything seems to be deflationary and imports decreasing? So is there I guess maybe that's a Mazen question. Are you seeing a specific product that is, or a specific category that's really driving that?
Yeah, definitely. Thanks for the question. So we are seeing a few sectors that are outperforming others. So if we're talking about non-durable goods or consumables, we're looking at personal care products and pharmaceuticals, and recently clothing and footwear. So these are sectors that are outperforming others in terms of spending, compared to sectors that have been mostly flat, like let's say spending on food and beverages. It hasn't been performing that well. So personal care definitely is leading with pharmaceuticals. When we're talking about durable goods or the big ticket purchases, we're talking about electronics, like laptops, cell phones, etc., and some spending that is driven by high income consumers, like jewelry, watches, etc. Some sectors that are not doing well include motor vehicles recently, and of course, because of the housing recession, furniture, appliances, like everything you buy when you move into a new house. So to summarize, a lot of consumption is driven by high income consumers and by goods that generally increase a lot of the dollar measurement of the dollar spend without increasing freight volumes. So these are high value, low volume goods like pharmaceuticals and electronics. These drive a lot of dollar spending so that the retail sales number looks better, but they don't contribute much to freight demand.
Got it. All right. Yeah, thank you, Mazen. Okay, next question. So I'll try to take a stab at this one, and then maybe Zupo. Okay, so what advantage does Uber Freight provide to large volume shippers when booking with the same few carriers on main lanes? Can a shipper benefit by going to carriers directly for high volume lanes? There's a lot there. I'd say we have a ton of different models inside Uber Freight, especially on our managed transportation business. We do have, several hundred customers that we, buy freight for. So we're able to kind of leverage those, broader buys with the carriers as much as we can, knowing there's different contract types, et cetera. So, in most cases, we would bid that out to the larger carriers and be able to get the, an adequate price and save that you'd feel good about. We do have some examples where, a shipper may have something very specialized that they kind of, do themselves or procure themselves, but I'd say that's probably the exception, right? But I mean, just overall, we're going to try to find the lowest landed cost we can, working with your team and the carrier base.
Yeah, there's not much to add to that, Nathan, other than it's all from a procurement standpoint, it's all scale, right? So if you're a large shipper, we're a very large shipper in aggregate, put that together, we get better scale and better buy. And additionally, we get some network leverage too. So we get to start looking at things like, back hauls, head hauls, and maybe get a little bit more creative in the bidding process to continue to reduce costs as well and create network balance for the carriers in the process.
Thanks, Russell. All right, so next question here. What is the best practice ensuring the year-long RFP is completed, but the internal network optimization occurs throughout that bid cycle? Do you want to do mid-year RFP or default to spot board, or kind of how do you manage that? Our best practice is, it's almost like we say you can't do the set it and forget it. I've been in networks where, even at the shipper side, it was on the shipper side, you'd bid a network, and then, 6 months later, you'd wake up and be like, oh my gosh, like this thing is, not running the way it should be. I gotta adjust. I gotta do another RFP. What we really recommend is doing that baseline level RFP, and then on a monthly basis, doing some sort of mini bid, either to like identify new capacity, repair, service issues, or anything that may be, not working well in your network. We really encourage that mini bid process on a monthly basis to like shore that network up, and it'll keep it from kind of falling apart at mid-year, right? As you're constantly maintaining it. It's kind of like, I'll use a terrible analogy, but we're all truckers, like doing maintenance on the truck, right? Like the more you put into the maintenance, the better it's going to run, right? And when you defer that maintenance, it gets messy. So that's really how we manage it with our customer base and with our carrier managers, kind of on those accounts. Okay, so next question, and then anybody can jump in. How is AI impacting procurement, carrier selection, and commercial relationship management? So I'll take a stab, and then let's see what Mazen and Russell maybe have seen up there. So from an AI standpoint, impacting procurement, I'd say it's definitely getting built into some of the larger software providers. So if you look at the large bid houses that we all know that run procurement software, they're out there saying we're integrating AI into the modules. Now, we haven't seen a ton of it go live, but like a lot of them are preparing to see what it can do. And a lot of it is around the data standpoint and getting data clean versus, potentially saying like, here's how I best select my carrier. I think it could eventually get there, but you'd have to inform it, quite a bit on what you'd want it to do from a carrier selection standpoint. I don't know, Russell, or any thoughts on just AI overall from a commercial relationship or anything?
No, I think you nailed it, Nathan. You really, in that space, what we're seeing is, the procurement software providers and sourcing systems are all moving really fast into AI. I would say the transportation aspect of what they do is sort of the last to come on board. So I think it's moving, it's going to be there, but I don't see any real impact yet in the market.
Got it. Okay. There is a question on here about Canada, and there was also one about LTL. And so I'd say if we don't cover specific modes or specific cross borders, those are both in the broader market report that you should be receiving. So very in depth on kind of both of those markets. And then if you have any questions after reviewing that, we're happy to reach out to your Uber Freight rep, and we can have some deeper discussions with you. So sorry we don't have an exact answer right now or an exact number, but we can definitely get there. And then I'd recommend getting through that market update first, the broader packet that we release.
I can speak briefly to LTL, Nathan. So
okay,
if we track indices like let's say the less than truckload PPI or the producer price index, so that's the official statistic by the government that tracks the LTL prices. We see that index is up 10% year over year. This is surprising given what the rest of the market is, with the truckload market being flat and intermodal rates also being flat. The key distinction here is that the LTL market is much more consolidated. So despite low levels of demand in the LTL sector, we really haven't seen any demand recovery. But despite the low levels of demand, carriers have more control over pricing compared to the fragmented truckload market. So LTL demand remains weak. It remains negative year over year, but rates are up about 10%.
Excuse me. All right. Yeah. Thank you, Mazen. So here, this is an interesting one. So with limited imports and the pending FMCSA ruling, do we see our nation's freight business continue to be profitable this year and continue to grow? Do you think it will continue to trend downward, since the pandemic? I'll take a stab just from kind of my history in the marketplace, about 25 years. It'll still be profitable. It'll turn. It's from a supply and demand factor, the pricing will change to support it, right? So from a profitability standpoint, carriers are going to ensure that profitability by increased rates as demand continues to increase. So yeah, I think in general, like you'll see a recovery at some point. And if you go back and look at the history of carrier earnings, you can see that like down times, they're running near 100 ORs, and then the good times they're running at 85, right? So yeah, I think you'll see that profitability will return to the carrier market, but we're going to need the freight market to really pick up a little bit for that to happen. Okay. One more question I see here, and if there's any other questions, please go ahead and key them in the chat. So what innovation is happening from your perspective in the industry that is improving predictability in capacity and pricing? I don't know if Russell or Mazen, you guys want to touch on that first, if you've seen anything out there floating around. I think I can touch a little bit on the pricing, but didn't know if you had anything out there from a big innovation that's coming up next. Yeah, I think it's a pretty open question. I'll go back and reference like the big innovation that's happening right now is AI, right? We're in it heavily. I think most of the leading edge companies are getting into it very quickly, understanding what it can and can't do. And I think that's the big piece of it is when you first hear AI, it's like, oh my gosh, it's going to solve the world's problems. But really, it's you have to train it, you have to understand what it's doing, and it takes time. And so it can't go from nothing to super complex. And that's where I think we're kind of at right now. We're starting to integrate AI into the businesses from our business plus the procurement networks and the software providers, et cetera. So yeah, I'd say if there was one innovation, that's the big one, and I think it's probably going to be sticking with that for a bit. Some of the other things you have working in there, autonomous driving, electric vehicles and stuff that have been around for a while. I think autonomous would be the next one that would make an impact as more and more lanes open up to where we can use those type of equipment.
Yeah, thanks, Nathan. I can add to that. I second your thoughts on AI. I also think like it's not the standard AI that it's not like traditional LLMs, but there's like other forms of AI that are more suited towards predictability and forecasting. Not necessarily LLMs or like not the standard Gen AI that we're seeing, but we are seeing in general AI, different types of AI getting used. The other kind of innovation is that data is made much more available than before. So now everyone has access to data on what's happening with rates or what's happening with capacity, what's happening with several indicators of the market. So this all improves predictability.
And that was our final question in the Q&A. Maybe we'll pause a minute to see if somebody else has anything else to pop in. But yeah, for all intensive purposes, that's kind of the slide deck in the Q&A. And so as always, we really appreciate everyone making time to attend. We know your time is really valuable, so like appreciate spending it with us and getting some good market conversations in as well. And love the Q&A questions. So thank those who asked that, and in future ones, please continue with that. So thank y'all very much, and I think we'll part now. So everyone have a good rest of the day and a good upcoming weekend.
Thank you.